All right, so good morning and thank you for joining today's webinar on trends in digital asset data and infrastructure. I'm Marcel Bluhm and I'm a research analyst at the Block. I'm very excited to host today's webinar and would like to welcome our distinguished panelists, whom I will introduce shortly. But before that, let me briefly outline today's topic, which is tied to our recently issued report on the state of digital asset data and infrastructure. Digital assets are employed to facilitate a variety of use cases, such as payments, real-world asset tokenization, and borrowing and lending. In conjunction with this proliferation of use cases, these assets are traded on dozens of centralized and decentralized exchanges in staggering volumes compared to 5 years ago. Naturally, this evolution renders navigating and operating within the digital asset landscape more complex than ever. In this webinar, we shed light on how service providers are making the increasingly intricate digital asset economy navigable and help industry participants extract value from a vast ocean of digital asset data. Our panelists provide insights into digital asset market and on-chain data, forensic and market surveillance data, as well as a perspective on industry needs. I'm very excited to be on this call with you for the next 60 minutes and would like to thank the sponsor of this event, Amberdata, for making this webinar possible. I invite our listeners to drop questions in the chat. We may pick them up on the fly where they fit in, or in case there's time at the end, in a separate Q&A part. Before kicking it off, let me briefly introduce today's panelists. We have Rajeev Bamra, Head of DeFi and Digital Assets Strategy at Moody's Investor Service. We have Shawn Douglas, CEO and co-founder at Amberdata, and we have Jardine, Cybercrimes Research Lead at Chainalysis. Let's start with a brief introduction from our panelists so they can share some of their background. Rajeev, can you please go first?
Yes, thank you, Marcel. Hello, everyone. My name is Rajeev Bamra, and I oversee strategic and operational initiatives for the Moody's Investor Service DeFi and Digital Assets Division. I'm delighted to be here as a member of this panel.
Thanks, Rajeev. Shawn, can you go next?
Yeah, sure. So Shawn Douglas, co-founder and CEO of Amberdata. We're the leading provider of digital assets data, market intelligence, and research. And we really help institutions, whether they be banking, trading, fund administration, market makers, get the data that they need so they can build their applications and business around digital assets.
Good morning, everyone. My name is Jardine. I'm a cybercrimes research lead at Chainalysis. We are a blockchain analytics company focusing not exclusively, but certainly in the main on analyzing blockchain data and making attributions of illicit actors, legitimate actors, and so forth.
All right. Thank you for providing your backgrounds. So let's dive in. First, I would like to set the stage and ask you to provide some general perspective on market developments and digital asset data. So 2022 was a very challenging year in crypto. How did this affect your business, and has this driven away institutional investment? Let's start with Rajeev.
Sure. So at MIS, or Moody's Investor Service, we provide market participants with risk analysis in the form of rating assessments, research, and various credit market components. We closely monitor credit markets and have seen an increase in their digitalization. So while our business model remains unchanged, we acknowledge that digital factors play an important role in credit risk. Therefore, it is critical that we inform market participants about emerging risks and how they differ from the known traditional financial risks. Furthermore, as a business, we must or we want to be ready for the digital evolution or acceleration of digitalization in financial markets. And hence, we want to make sure that our business model can adapt to changing market participants' needs and preferences, such as those who prefer to interact with us via digital platforms. On your reference to recent crypto winter, institutional investment has not fled the market. In fact, we are seeing ongoing investment in the underlying blockchain technology.
Yeah, and I can echo that from the Amberdata side. We actually had our best year ever, and despite crypto being down 70% and us relearning about counterparty risk and bad actor behavior, we see the market is massively growing, and I think digital assets is really the financialization of the internet, and it's going to touch every business and every person on the planet. And we're seeing traditional financial institutions leaning into the vacuum created last year, and really building businesses at a pretty fast pace around this space. So I'm still very bullish on the market, and it's primarily institutional interest that is leading the charge here. And that's a global platform. That's not just the US. We're seeing that across the US, Singapore, London, Europe, Dubai. It's a massive opportunity.
I think for my part, I'd echo the adoption sentiment that Rajeev and Shawn just made. I'd also add, I know there's obviously a heavy emphasis on institutional adoption. We can talk about some of the prerequisites for that sort of influx. I think it's an error to not reference peer-to-peer adoption and grassroots adoption, which we track in our GEOS report, simply because it provides the sort of transactional base for a lot of activity on the various blockchains that we happen to track, for example. And I think one other thing I'd say just along these lines is that one of those prerequisites for institutional play in this space is what happens on, say, a blockchain. If it was all crime, you wouldn't have institutional adoption. You'd have the development of, say, a private ledger, maybe leveraging blockchain technology, but it probably would be more centralized than decentralized at the end of the day. And so in that sense, 2022, from our perspective, while total illicit volumes went up, we still nevertheless saw pretty significant drawdowns in most forms of illicit activity across the board, the two outliers being stolen fund activity and sanction-related activity. And so in that sense, the ecosystem, it didn't tidy itself up completely by any means, but it certainly, when you had a bear market conditions and the rollout of products that help you do identification of transactions and so forth, these are actually positive developments. So I would echo the sentiment that 2022 was bad if what you were doing was watching the spot price for Bitcoin. It was not bad from almost every other aperture.
All right, thanks. That's good to hear. Very interesting. So let's shift the focus a little bit more towards digital asset data. At a high level, what makes digital asset data special compared to traditional financial or market surveillance data? Shawn, can you start with that one?
Certainly. So, at Amberdata, we do comprehensive digital assets data. What that means is we connect into every spot market, derivatives market, option venue. But where it gets really interesting is the on-chain data. And what makes digital assets data unique is there's radical transparency that information is available. The data is available. The information is really, really difficult to get. However, via the data that is available, you can see what is happening in these financial networks, in these applications, where you can see the inputs and the outputs of every mechanism that's in a smart contract. And if you think about what's happening with digital assets, you're factoring out financial services from closed proprietary networks or applications and putting them on public blockchain networks. So you can understand the participant behavior, you can understand who held what, when, what else did they hold. But to do that, you need to parse not only the database but in the network and the application. You have to understand kind of what is what's happening in the entire stack. And that's very different than traditional financial data, because that is quarterly reports and daily trading volume. But here we actually get real-time seeing the real-time cash flow of these financial applications, and it's a permanent record that can't be changed. So it allows people to really understand and quantify opportunity, risk, what happened, why, who benefited, who didn't. It will be an amazing opportunity in the future because of that.
Thanks. Eric, can you provide this a response from the perspective of what Chainalysis is doing? So what makes digital asset data special compared to traditional financial or market surveillance data?
Certainly. So I think, again, I'd echo Shawn and the transparency point. The radical transparency of blockchains is fantastic. Now, they are, of course, pseudo-anonymous, so you can tell entities are interacting, but you may not be able to tell who they are. And there's an added layer of intelligence that needs to be collected in order to start to make sense of that dimension of the transparent ledgers. I would also add, I think, that there is an immutability to the history of transactions that's also worthwhile to bear in mind, because it certainly implies that not only can you tell in real time who's transacting with whom, but you can also then look backward in time, back to the beginning of, say, Bitcoin, and tell who's been transacting with whom over that full period, which is, especially as we move into a world that's facilitated by machine learning and AI, you're going to get into a world that's able to leverage those historical periods and that transparency quite well. I think the last thing I'll say, simply because I read a really fun book on the plane the other day, is if you look at something like Bitcoin as a monetary instrument, then some of the challenges with things like the quantity theory of money, where how do you quantify, say, for example, the velocity of transactions as a part of that equation, things like blockchain and the transparency of it allow you to essentially do that estimation in a better way than you are able to do with traditional financial instruments, because of all the private order books and all the rest. And so I think there's a lot of advantages anchored in that transparency point that Shawn made, and then expanding out to this, historical immutability and so forth.
All right, thanks. I just got a flashback to my macroeconomics lecture with the quantity theory of money. So very interesting. Rajeev, do you have something to add from the perspective of Moody's, like what makes this digital asset data special to work with from your perspective?
Yes, of course, and I do support the thought that Shawn and Eric shared. So we do know that, or we at Moody's believe that the monitoring and regulation of financial networks could change as a result of digital asset data, potentially creating a more transparent and secure financial system. So if everything were digital and stored on a blockchain, it would be possible to create a fully interconnected digital ecosystem capable of continuous monitoring and compliance, thereby improving transparency using in real-time performance data, which could help market participants monitor the entire ecosystem in real time, identifying potential risks and compliance issues before they become a problem. So, however, numerous obstacles must be overcome before this vision can become a reality, including inconsistent regulations, as well as legal and cybersecurity risks, among others.
Thank you. Yeah, so I have some questions prepared on regulation that will come up later. So please hold that until you can release it at that point. So before that, Eric and Shawn, I would like to drill down a little bit deeper on challenges in collecting and processing raw digital asset data. So you mentioned they are available 24/7. It's not that there is like an interruption, I don't know, 4 p.m. on Friday, where the data flow stops, for example. So in the report, we distinguish between market data, on-chain data, and forensic and market surveillance data. Can you provide us with some insights what makes it difficult to obtain and process those data before delivering them to the end users? Eric, let's start with you.
Sure. So a few thoughts here. One would be that one of the big challenges is, at least in the blockchain setting, an issue of attribution, that you have known addresses interacting with one another. You can observe those addresses. That's all well and good. And that is one of those clear advantages of the technology. But then you don't know who's behind the address. And so if that entity, for example, that's operating that address and sending money out to, say, an exchange or something like that, if that happens to be a sanctioned actor, then there are compliance risks that are associated with that. If it's actually ill-gotten funds that have been stolen from a DeFi protocol and they're using a mixing service, then there's issues in that respect. So I think one of the big issues with these data is the need to attribute some sort of identity to the addresses. Now, it doesn't necessarily need to be like a KYC derivative real world identity, like it's Shawn, or Eric. It could be something broader than that. And often in our data, for example, we have a category level attribution. So you're a scam. And then within that, we have more fine-grained categorizations. So that's a way to help make sense of blockchain data in a way that's quite useful, I think, from market participants. The other thing that I would say is that one of the things that remains an issue in the traditional financial system and certainly spans over here is that sometimes you don't know what you're looking at. And so you have to analyze the data with a mind towards essentially establishing an arbitrary rule that's defensible and then leveraging that rule in order to make sense of some of the on-chain data that you happen to be observing. So for example, one of the reports that we put out recently was detailing market manipulation tactics, and we found something on the order of 24% of new tokens were subject to pump and dump behaviors. Now, that whole process of coming up with the 24% figure is a result of a series of ways in which we slice the data. I think they're plausible and are ultimately defensible, but there's that need to, you can't tell from the name of a token that it's necessarily a pump and dump scheme. You may need to leverage additional information and apply some analytical tools to really make sense of that. And so I think I would highlight those two elements, the need for attribution and then the need for some analysis to be overlaid on top in order to really make sense of, say, on-chain data.
Thank you. Thank you for this insight. Shawn, can you provide your perspective on that?
Absolutely. So, I think why it's difficult to obtain market data, on-chain data, and then for us interpret that data and build market intelligence products is that, if we serve primarily financial service firms, whether they be front office trading, portfolio management, research, kind of middle office risk or treasury, back office, fund administration, audit, tax applications, right? So when you simply want to know what is the price of Bitcoin. Okay, the price of Bitcoin where? In what region, on what exchange, denominated by what currency? That's actually a really difficult problem. And if you look at, 95% of the world's trading volume in cryptocurrencies happens spread across about 30 different trading venues between spot market, derivatives markets, and options markets. And those all have different APIs. They have various levels of documentation. Even the way that they do their order book level data is drastically different with some having sequence numbers, some using timestamps, some marking end of day at a different time, some using different ticker symbols for BTC USD as XBT, foo, whatever. It becomes incredibly complicated to simply just ask and answer, what is the price of Bitcoin today, right now, or at 4 o'clock Eastern time, so I can settle my books. So what we do is we connect into and normalize all of that data to a unified timestamp. It's a massive undertaking, keeping up with fast-moving breaking APIs. Now, from an on-chain data perspective, it's also incredibly complex because in a blockchain, every single block has no state, has a state at a point in time, but no context of the block before it. So to create meaningful information out of that raw blockchain data, which is pretty much useless on its own, you have to have a lot of intelligence that can create a time series of who held what when at what price, and be able to map the token name, map the internal transactions, map the internal functions, understand and parse the logs and events to create data and create meaningful information from that data. Now, if you want to do market intelligence on top of that, now you're looking at what are the fundamental mechanisms for each of these protocols. Say you're looking at Aave. Okay, it's a lending marketplace. What pools are available? What are the interest rates? Who are the participants? What are the flash loans that are being facilitated? What are they doing with that? What are the credit risks of the individuals? Now you have to understand the protocol, the mechanisms, the inputs, the outputs, and then understand that behavior. So it's significantly more complex because of the distributed nature, the complexity of the data. And we've spent tens of millions of dollars building that infrastructure to make it easy so anybody can simply, for the cost of an engineer, get an API key so they can build a data-powered application and not deal with all this complexity. So it's really, really challenging. It's a fun problem, but it's not most people's core business is ours.
All right, thank you. So speaking of tens of millions of dollars to set up that infrastructure, so exploring and setting up data coverage for additional ecosystems such as new blockchains or protocols is very resource intensive. And so ranging from setting up the infrastructure such as nodes to doing due diligence. When are ecosystems mature enough so you cover them in your data offerings and ecosystem investments? Rajeev, can you first provide your perspective on that one?
Yes, absolutely. So what we do at Moody's, data is everything, and we give it highest priority. So with that, we recognize that data is constantly changing, and it is critical that the data we use is both relevant and reliable. To accomplish this, we have a rigorous process in place for triangulating, assessing, and qualifying the data we use in accordance with our data management policy and data classification standards, which ensures that all data is classified at the appropriate level based on the risk that the information discloses and the intrinsic value it has for our business, so that it receives the appropriate level of protection. We also always strive to use the best data available and assess the sufficiency, adequacy, and reliability of information when making rating decisions and conducting research. So for that, we evaluate the quality of new data as soon as it becomes available to determine its suitability for our purposes. Given the current limitations of data and historical records, we do realize that full automation or control measures are not yet feasible. As a result, both we also believe the wider industry have to rely on manual intervention to address these gaps. Basically, at the end of the day, we want to make sure that the data we use is accurate, reliable, and relevant for our needs.
Thank you. And Shawn, from your perspective, so when is an ecosystem mature enough so you start harvesting data, processing those data, and delivering them to the customer?
Yeah, so if you look at what we do, again, it's very expensive because we have to run a highly available environment that dynamically scales, that can meet the needs of our customers calling us, tens of millions of times a day. So in order to do that, first, we process the real-time exchange data we ingest. We store that. Any asset that's listed on any exchange that matters, whether it's a spot, futures, or an option, we capture that because it's listed. It matters, right? From an on-chain perspective, we actually capture every address, every transaction, every function call inside of a smart contract, which is effectively a mechanism, and you can use that data to reconstitute what matters on something that was created right now. However, where we invest, 6 months, a year, hundreds of thousands of dollars to go down the rabbit hole is, for us, it's usually when there's about $500 million total value lock. Total value lock's not a great metric, but it's a metric. So when is it meaningful from a financial perspective and participation in these protocols that institutions will care about it? Then we go super deep and we make massive investments to understand, for my wallet, what's my participation? For the pool, what's the participation? For the protocol, what's the participation? What are the mechanisms? That's where we make that huge investment. And those are big, big investments. And, we've gone crazy deep, way deeper than anybody in that space because we pick the ones that we're going to, go, okay, we're investing in this.
All right. Very interesting. Eric, from your perspective, do you have similar triggers like Shawn mentioned the 500 million total value locked? Like from which point onwards you start to covering ecosystems and
Sure. So
protocols?
Not the same quantitative figure, certainly, but we have to Rajeev and Shawn pretty much a similar in general principle methodology. So we have varying levels of coverage as a function of the maturity of the various blockchains that we track. So we're keeping an eye on everything, and then we kind of determine as a function of, say, market cap, total value locked, and a variety of other measures. Whether you'd be in, for example, the mature category, so something like Bitcoin or Ethereum are obviously going to be in that category, or if you're going to be in the emerging or pre-growth categories, which we would sort of categorize as chains that are worth keeping an eye on, but not necessarily at a level where there's enough activity to necessarily warrant the capital investment that would be required to do wide sale attribution, for example. But throughout all of that, we're also staggering what kind of activities we're doing vis-a-vis each of these chains in each of these categories. So comprehensive coverage comes with the mature category, but even if you're in a pre-growth category, we're still paying attention to some of the higher risk activities that might be associated with blockchains, like terrorist financing or something like that. So it's not like we're just ignoring them or anything of that nature.
All right. So the next one is for Rajeev and Shawn. So in the traditional finance sector, derivative volumes dwarf spot trading. In crypto, this applies to perpetuals and futures, but options still seem to have a lot of growth potential and are strongly concentrated on one exchange. So from your perspective, what is the outlook for crypto derivatives? Do you see more trade moving on chain, and how does this affect data provision? Rajeev, can you jump in first?
Yes. So the growing trend in the crypto market toward on-chain derivatives trading may have significant implications for data provision. Currently, we see or notice that centralized exchanges provide the majority of the data used to price derivatives products. However, as more trading activity moves on-chain, new data sources will be required. So data from decentralized exchanges or blockchain analytics providers would be included in that universe. It is worth noting that traditional derivatives markets are heavily regulated, which ensures market participant safety. On the other hand, the crypto derivatives market is currently largely unregulated. So while the development of regulatory frameworks may result in a more secure and stable market for crypto derivatives, the absence of such frameworks can stifle real growth. However, in order to accurately price derivatives in DeFi, it's essential to have high quality and sufficient data, as well as multiple oracles. That said, this approach also carries a risk, as demonstrated by the recent Mango Markets incident. And we also wrote a report about this a month or two ago, where someone exploited a design flaw in the platform's use of data sources to manipulate the price of perpetual swaps. So comprehensive regulatory frameworks for DeFi markets, which will likely take years to develop and implement, could be embedded directly with distributed ledger technology at some point. However, in the interim, regulators are taking steps like they did with the Mango Markets incident to enhance the safety of the DeFi ecosystem by regulating activities rather than specific entities, which makes sense at this point. This approach enables enforcement agencies to take appropriate action against wrongdoers and mitigate risks for investors.
On that Mango Market exploit, so I think Avi did not get away with his very profitable trading strategy, though. They caught up with him. So
find everybody at some point. There's a permanent record of all of these people's behavior, right? Yeah. So you were going to ask me. Yeah. Look. So to your point, the derivatives market for equities and for futures dwarfs spot markets, and I think from an institutional interest and really from a global market perspective, we're seeing massive growth in this space. And because derivatives give you a lot more surgical control over your risk, especially options. And there's some institutions that want to get exposure to the underlying assets, and they don't want to worry about custody. So therefore, they operate in venues where they can get exposure and not have to deal with custody because they're dollar settled futures contracts or their dollar settled options contracts. We're also seeing, you mentioned earlier that derivatives, a large part of the market. So they're like 90+% of the options market. However, CME's business is massively growing. I think it's probably just a matter of time before the other US regulated exchanges move into derivatives and options trading. It facilitates much more sophisticated risk management, and that's really what it's about. It's how do you get exposure to a 60, 70 vol asset without ripping your face off. And derivatives give you that control and that flexibility. And now the movement on chain, we're also seeing now quite a few new protocols starting to emerge to give either perpetual futures contracts or options or even portfolioed options risk management perspective on chain. The market's fairly nascent, it's still small, but we've invested a lot of time specifically in that, even though there's not $500 million total value locked in those protocols, because our customers are demanding it. And then the last piece that's pretty interesting is you're now seeing most of the banks on the planet now actually building non-deliverable forward futures contracts for their private banking customers, because in the implosion of FTX, which used to be the majority of dollar-denominated futures trading, it is now most of the bank's private banking customers have exposure to non-deliverable forward futures contracts without having to hold the underlying spot market asset. And they're even creating structured products around giving people the ability to harvest yield effectively off Bitcoin or what have you, and sell covered calls via structured products, etc. So I really think that the future is going to be derivatives, just like all other assets.
All right, thank you. So you mentioned there's this nascent development of perpetuals moving on chain. So just to drill down a little bit more there. So do you see that this is like really a trend that is increasing, this move towards on-chain activity, probably driven by the default of many centralized players in 22? And so do you see a movement away just from these centralized players towards on-chain activity? And so how is this reflected in your business activity and offerings? I would guess, so if you see that trend, that you are building out this DeFi section, this on-chain section. And do you see in parallel increasing institutional demand for this? Given that you mentioned there is not really a firm regulatory framework yet, so is the demand already there? Is it holding back, or what's your insights there, Shawn? Can you?
Yeah, absolutely. I can talk to this. So first, we're seeing an explosion in on-chain trading activity, whether it be facilitated by protocols like Uniswap or in derivative protocols. There's a long list, and you've literally seen on-chain activity in some of these decentralized exchanges dwarfing Coinbase, right? So it's interesting, and part of that is possibly driven by understanding, control your keys, your crypto. I want to not have to worry about my counterparty, etc. So I think that we're continuing to see that. There's also innovation that is happening that has the institution's interest, right? Like every participant, they're like, wait a second, I can be a market maker or a liquidity provider if I operate, all the rules are published, it's transparent, I can study my competitors, I can understand what are people's position sizes, what percent of the market, what's my price impact, what's my slippage. It's really unique financial laboratory. So we're seeing a lot of traditional market makers and bankings and investment firms coming in and starting to experiment, or being really, really good and making a lot of money, participating in those decentralized protocols, lending protocols, DEXs, etc. So I really think that the DeFi is the future. And there's now how it plays out over time with regulatory frameworks, which I think Rajeev will talk to next, or what have you. Like, you got to operate in the rules, and people need that clarity. So I think but that's where the innovation is happening for sure.
Yeah, thank you. Eric, from your perspective, how do you see this? Do you see this trend that we are moving more towards DeFi, and how do you perceive this?
I think the general answer is yes. We have certainly observed during the course of 2022 significant outflows from centralized exchanges. They're punctuated at the various points. I'm sure everyone would kind of be able to guess. That's a sign of moving on chain, and then if you want to regain access to financial markets, you can move through into DeFi. I think one cautionary note I would add, just because being on the crime side, that's sort of everything I do is just sort of cautionary notes, would be that we do observe with DeFi and NFT marketplaces and elsewhere, some of the transactional volumes have a bit of a questionable pedigree. So with NFTs, for example, it's not uncommon to observe NFT wash trading. Most addresses tend to lose money in this respect, but some of them do extraordinarily well by essentially bidding up the price by being on both sides of the transaction. And so it's in no way saying, I think, that DeFi's future is bleak or anything like that. I would agree, I think, with Shawn wholeheartedly, and I suspect with Rajeev when he goes on this same subject, that DeFi is likely to be a cornerstone of financial markets in the future. It's only that at the moment, some of the early entrants are getting a little bit creative. The mango market would be another example, with how they use these protocols. And since they're not sort of clamped down in the same way as a centralized service, you do have more leeway to basically get creative within the code. And that's sort of what we've observed over the last few years.
All right. Rajeev, can you add to this from your perspective?
Yes, of course. And thank you. I agree. And Eric already said, so I second what he and Shawn just said. And I agree entirely with that. And we did also mention earlier that despite the recent downturn in the crypto markets, some organizations are and have been continuing to invest in and develop applications using blockchain technology for a variety of reasons. In fact, when crypto values began to fall around the end of last year, we have seen more digital bond issuances in recent months than in previous years. And it's crucial to stress that these issuances are unrelated to the crypto finance sector. It's more to do with the blockchain and the underlying technology. While crypto finance has suffered in the recent months, it's worth noting, and we all know that DeFi, and most of us know that DeFi protocols have done fine throughout the crisis. As a result, DeFi has demonstrated greater resilience in times of market volatility and is undoubtedly one of the reasons why it has garnered so much interest. But we also notice, and we've seen that in the recent months, the amount of funds locked in DeFi protocols has dropped significantly from a high of around $150 billion to around $50 billion like recently, or even today, probably it's around that number. So this downturn is the result of a number of factors like increase in interest rates, inflation levels, rate of return on treasury bills, etc. And we believe and think that for DeFi to scale and be widely adopted, it has to, or it must go beyond its current limitations. So in practice, DeFi is primarily accessible to those with computer engineering background or computer science professionals, and it limits its potential to address So to address this issue, there must be more work done on the interface design to make DeFi more accessible and user-friendly. Also, in addition, at present, tokenized deposits, stable coins, and CBDCs, potentially CBDCs in the future, would make a relatively small part of crypto finance, which also limits the potential impact on DeFi. So to promote DeFi adoption, these tokens need to be and must be used more widely, and there must be greater interaction between DeFi and the traditional finance infrastructure. So it is worth noting that DeFi is currently dominated by unbacked cryptocurrencies and some stable coins, and there is need for more digital tokens in the DeFi ecosystem, including asset tokens. Without this expansion, we think DeFi will remain limited to cryptocurrencies and unable to grow. So to second Shawn and Eric, it's important to remember, or it's important to understand that DeFi is still in its early stages of development and has the potential to revolutionize various industries in the future if it is properly supervised and safeguarded.
Just to clarify there, by these assets that should come in, you are referring to so-called real-world assets, like tokenizing, let's say, treasury bills, or
that is correct, yes.
Or even no. All right. All right, very interesting. So, and then I would like to add one regulatory question for you. I promised that before. So the previous questions which we had can also be looked at from a regulatory angle. because this affects whether the space is investable for institutions. So from an investor perspective, so what is the role of regulation and how does it influence your business model and growth? And do you unequivocally assign a positive role to it for the digital asset space?
So one word answer is yes, and the implementation of regulatory frameworks we believe will have a positive impact on the digital asset industry. The APAC region, for example, is currently working on a number of regulatory developments. The EU is planning to implement a DLT regime in the next couple of weeks, while their MiCA regulation is set to take effect in 2024. We also see and realize that the UK is closely following the EU's lead, and more regulatory developments are expected in the near future. However, at least in the near future, the US is unlikely to enact comprehensive regulations similar to those seen in other regions. Although most bills and proposals that we've read around the world globally will only regulate or are set to only regulate centralized financial institutions and not DeFi, this will help consumers regain trust in CeFi and potentially increase trading values and volumes in the crypto market or the crypto finance industry. Currently, institutional investors are not heavily involved in the world of pure crypto finance. However, with a cautious approach to cryptocurrencies and other crypto assets to date, combined with new cautious regulatory guidelines and recommendations, the introduction of regulation can help stabilize prices of highly volatile assets and, with appropriate safeguards, invigorate the crypto finance market. So with that, I would summarize in a way that that we believe at Moody's that regulation is advantageous to the digital asset industry, but without global coordination, even comprehensive local or domestic laws will do little to prevent cross-border regulatory arbitrage and the resulting abuses. This situation might lead to the emergence of two parallel crypto industries, one a regulated part that would attract mainstream institutional and retail investors, and a segment with little or no regulation where some investors with higher risk tolerance and possibly illicit actors will continue to invest through offshore entities. So if such a scenario unfolds, regulators will likely limit interactions between the regulated and unregulated areas to ensure stability.
Thank you. So overall, the outlook is positive, but we don't know if this may lead to a bifurcation probably down the road into a regulated and unregulated world in DeFi. Eric, of course, regulatory requirements are also strongly impacting your area of business. So what are the challenges and opportunities in digital asset regulatory sanctions and AML compliance? And how can blockchain analysis help there?
Yeah, it's a good question. So maybe one way to think about it would be through some numbers and an example. So last year we tracked $23.8 billion worth of funds flowing into centralized or flowing into services in an effort to money launder illicit funds. Now, of that total, over $1 billion flew into 4 deposit addresses on exchanges. So you have this remarkable concentration of illicit funds flowing into a small number of deposit addresses. And really 5 exchanges out of 900 and some were accounting for about 68% of illicit fund inflows that we observed during the course of the year. So I say all of that just to provide some context on questions like KYC and AML related regulation, because just because funds flow into an exchange does not necessarily mean that those funds are successfully off-ramped and laundered, because it depends on what the exchange does. And what the exchange does is partially a function of what regulations exist and oversee that exchange, and then their degree of compliance. And so in a setting where you have a well-regulated exchange with clear KYC rules, AML rules, and so forth, and a good compliance team at play, you can leverage products like one of ours called KYT, which stands for Know Your Transaction. And then you can observe these funds are coming in from an illicit source, a sanctioned entity, a stolen fund wallet, a scam, a darknet drug market, what have you. And then you'd be able to behave appropriately as per the regulations on the other side of things. So if it's a sanctioned thing, you file an SAR. If it's ill-gotten gains that are a part of a ransomware gang, you can turn over the KYC information for the account holder on that deposit address to law enforcement. And so there's a lot of ways in which regulation of especially exchanges can be highly beneficial to the security of the ecosystem. And all of that is to say, when you have illicit actors sending funds into exchanges, it doesn't mean that the regulation isn't somewhat in place already for many of these organizations. What it means is the illicit actors have very little choice if they actually want to off-ramp, because there are some illicit services like Hydra Marketplace that was shut down in 2022 that do provide fiat off-ramping services, but it was Russia-based and it was in rubles. So it's not going to be very good for, say, Western world or United States-based illicit actors or something like that. So there's a lot of opportunity, in other words. There's points that illicit actors are almost inevitably, at the moment anyways, going to need to interact with. Largely, those are exchanges or high-risk exchanges. And regulation can help sort of tamp down that off-ramp potential and that money laundering potential. And of course, the risks here can kind of be split into compliance-related risks for the entities that are subject to regulation. If they don't file an SAR, if they're receiving funds from sanctioned entities, that's bad. If they fail to act appropriately, receiving funds from ransomware gangs, that's bad. And then you've got a sort of another question, which is the question of regulatory risk from more of an economic standpoint, as opposed to a compliance or illicit activity standpoint. And in that sense, you want to make sure your regulation isn't so stringent on vectors that are hard to kind of deal with that you end up tamping down innovation. And so I think there's a lot of opportunity, and ultimately regulation has a very core role it's going to play in the digital asset space. But I'm always wary of the possibility that such regulation might try to demand of a technical protocol something the technical protocol can't do, for example, and then you end up in a weird space where compliance is impossible, and then so on and so forth down the road. So.
All right, thank you for that perspective. So in the remainder discussion, I would like to turn more to an outlook with you. So where do you see the market and your business in the near term and over the next couple of years? And what are the key use cases you see driving adoption? Eric, can you start with that one?
Yep. So I think adoption is going to continue to increase. Adoption is going to continue to increase, I think, for a few positive reasons and a few negative reasons. On the positive side of the ledger, I think some of the innovations happening in the digital asset space are bound to, for example, draw in institutional investors. They're going to continue to provide retail investors with a variety of ways that they can engage with some of the more esoteric financial instruments that Shawn was talking about before, the derivatives and the options and so forth. And so I think that will certainly create quite a large pull factor, pulling people into the digital asset space. I think what we've observed during the course of 2022, and it seems to be continuing into 2023, is that there are also, unfortunately, going to be push factors. And these, I think, are largely going to be surrounding currency collapses, like we've observed in several places around the world. More currency drawdowns, like we're observing in, say, Canada or the United States, where persistently high inflation leads to a reduction in purchasing power, all of which are likely to push people towards some forms of digital assets. Certainly not all of them, but some, like Bitcoin, for example, that bills itself as a monetary instrument. It's likely to benefit over the long term from these push factors. And then you have the sort of extreme push factor of actual governmental collapse, which we observe in a few places. And unfortunately, in those settings, people will pivot to, I think, things like Bitcoin again, because it's able to preserve some value, and it's a bearer asset that's transferable if you yourself happen to have to get out of a country, for example. So I think through this combination of push and pull, some of which are positive things, some of which are quite negative things, I think we are going to see adoption continue to increase. And that's what we've observed in our various geos reports over time. Is basically a continuing adoption of digital assets across the board. And there will obviously be patchy growth and development across the world as a function of various things, but adoption will increase. In the final thing, just on the sort of monetary side, obviously, if adoption goes up, presumably everything else being equal, so will price point. But making predictions in markets is like a really poor idea. So I'm not going to go too far down that rabbit hole other than to say, presumably, when one goes up, the other should go up too.
Thanks, Eric. Shawn, can you provide your perspective on that?
Yeah, absolutely. So, like Eric called out, global macro drivers, catalysts, geopolitical risk, ability to transfer wealth globally. It's kind of the core tenets of digital assets and decentralization. I think that, it's an uncertain world with lots of bad things happening, and it's that use case continues. I think that more interestingly for me in my business is that with the creation of digital assets, whether they're new financial products or they're simply digital rights management, a la NFTs, or the taking of real world assets and encapsulating them into a representation, tokenization, securitization, whatever you want to use as the vocabulary of bringing those out of private behind a single company's, firewall or what have you onto a global network. You enable your total addressable market to be every person in every business on the planet rather than, ring fenced into where I live. So I think that will be the biggest driver for the adoption of digital assets, where this becomes the financialization of the internet and the fabric for the creation of new financial products. And instead of paying, your monthly AWS bill every month to build something, you can build a product that runs globally on somebody else's computer, and you pass the transaction cost to your customers and create products that you couldn't create before in a much faster way. This is going to be like, we're going to look at this probably, 20 years from now, and you look back and it'd be like the internet, like brick and mortar businesses versus the internet. You're like, this is just obviously going to happen. And I think that it's interesting, as well as the areas for growth, is the geographic locations for this. You see emerging markets, and you see the UK right now is massively embracing digital assets, and that they're looking at, I think that they're positioning themselves to be the next Singapore of financial services by embracing this. You have Singapore, still Singapore, they're doing what they do, and then you have UAE and Dubai making massive investments in bringing in innovation and bringing in entrepreneurship and putting structure in place to facilitate that growth and adoption of what's happening. I think the US will figure it out. We've got a lot of different regulatory bodies, like whatever. I think that the growth opportunity this is global. This touches every person, every business. This is a new platform that causes a paradigm shift in your access and control of the things you own and the transparency about that. And that creates kind of a whirlwind of disruptive opportunity that's going to, we're either going to participate or you're not,
Thanks, Shawn. Rajeev, can you add to this?
Yes, and I would be repeating what Shawn and Eric said. So I'll just try to share our overall strategy and how we look at it, because we recognize that markets are shifting to digital channels, and therefore we decided to kind of have a three-pronged approach and divided our digital finance strategy into three broad categories. The first one is digital infrastructure, which includes all of traditional financial assets and transactions that are being made, or some of them have been made more efficient and potentially cheaper by the use of distributed ledger technology, such as digital bonds, asset tokens, security lending transactions. The second category is more broader in a way that we decided to kind of look at it from the lens of a native digital assets, which essentially refers to all the new novel assets and product structures that are made possible by cutting edge technologies like blockchain. In fact, in this category, we not only kind of look at native tokens, unbacked cryptocurrencies, stablecoin CBDCs, but also DeFi protocols they are native products, so to say. Like, there's still more to learn about them. And the third category is digital exposure, which basically includes existing financial structures, legacy systems, as well as everything in the second category of native digital assets that are or can be susceptible to digital exposure. And that's also the part of the risk management work that we do. And examples are all incumbent banking institutions, financial institutions, asset managers, all exchanges, CeFi, DeFi, and even others. So what all of this basically necessitates is a comprehensive approach that includes process optimization, data and technology, operations and risk management. And we are currently in the proof of concept and testing phase, where we are collaborating with our colleagues from various business sections within Moody's, as well as leveraging data from partners such as Amberdata to be prepared for the future.
All right, thank you. So just the final question, Shawn just mentioned, he brought in this regional perspective when he said, okay, we have in the UK, there's strong development, there's Singapore, there's Dubai. So Rajeev and Eric, do you concur that do you foresee an increasing relevance of Asia and Europe going forward, as long as the US is trying to figure out what's the right approach to crypto and digital assets?
So we briefly touched upon this, and I think Shawn touched upon this as well on the previous question.
Yeah.
The EU and APAC region, significant amount of work has already been completed and published. Meanwhile, in the US, regulators are actively engaged in the development of policies related to digital assets, and we anticipate further action from policymakers in the near future. Regulators around the world are working to strike a balance between protecting investors and promoting innovation in the crypto industry. And it is essential for regulators to provide clear and appropriate regulatory frameworks that would foster a stable and secure environment for digital assets to grow and thrive. So as the industry continues to evolve, it will be important for all stakeholders to engage in constructive dialogue with regulators. And we are seeing some of that already happening, and work together to address any concerns and uncertainties. By doing so, we believe we can ensure that the regulatory environment for digital assets can be fair, transparent, and conducive to sustainable growth and development of this industry.
Thank you. Eric, would you like to add to that?
Sure, I'll just say a few things. It'll actually speak to both of the questions in the Q&A box as well. I think one of the things from my perspective, when talking about the question of adoption, and especially the regional question of adoption, I like to decompose that adoption dimension into component parts, because it's definitely seems to be the case that some countries, for example, have adopted DeFi fast. Others are adopting it slower, but they may be adopting Bitcoin as a monetary instrument fast. And this difference is largely attributable, I think, to regional or country-specific settings. So in El Salvador, as the classic example, you have Bitcoin as legal tender, which has implications for adoption in that country. We're seeing other inklings in that direction from several other countries as well, and some municipalities. And so you start to get into a lot of sort of the multiple use cases that Shawn was sort of speaking. NFTs as property rights, Bitcoin as a monetary instrument, DeFi as an alternative to centralized financial instruments. And really, I think it all boils down to, like, what do you need in your context? I have access as a Canadian to stable banking infrastructure. I don't necessarily need to use some of the services that crypto can offer. However, if I was in a different context, it might be essential. And so we are seeing broad-based adoption across various regions, but it's largely driven by different things in different places. And to the question about IoT, just one example that also intersects with sub-Saharan African development and adoption. There's a company called World Mobile working off of the Cardano blockchain that is essentially distributed air nodes in East Africa. And it creates sort of a mesh network that allows for internet access while having a tokenized system through the World Mobile token. So you have kind of this interaction of blockchain plus IoT plus other things all coming together in a single place. So that would be my sort of final thought on the adoption question. It's just you need the adoption of what dimension, and then you can say how is it likely to play out in different country settings, for example.
All right, thank you, Eric. Just to briefly also give you a chance, and Rajeev and Shawn, would you like to add to the questions which were asked by Tricia in the Q&A part? So if you want, I can read them. So first question was, are you seeing an increase in adoption in South America and Africa? And then are you all seeing any successful blockchain-based applications that are utilizing IoT and DeFi?
For the regional perspective, we're absolutely seeing Latin America. We're not involved in any projects in Africa, but I know a lot of people that are. So, but I just don't have personal experience there. And IoT, I don't really have much visibility into that.
Yes, and I think I agree. I mean, Latin America, Africa, I think the most important and the largest use case that we are seeing is in the payments side of things, cross-border transactions, and the use of digital assets in terms of how payments can be sped and cheaper transactions. And on the IoT side of things, I agree with Eric. That's the only use case or project I knew about. But that is an interesting question, more to learn, and hopefully we'll have more next time.
All right, thank you. So I regret that I have to point out we are running a little bit over time already. So this has been a very interesting discussion. We covered lots of ground on digital assets and provided perspectives from two data service providers, Amberdata and Chainalysis, and the customer or professional investor perspective from Moody's. So one thing I will keep in mind is that the next growth leg in this space will likely depend in part on that regulation is done and that it is done properly, also regarding international cooperation and coordination in particular. So it has been a great panel, but before closing, I would like to ask my panelists where our audience can connect with you or follow you, for example, on Twitter. Rajeev, do you have a Twitter handle where people can follow?
No, the only social media portal, if I can call it social media, is where I am is LinkedIn. So you can look up my name, and I try to be as active as I can on LinkedIn. Yes.
All right, thank you, Shawn.
Yeah, Amberdata IO is all one word on Twitter, or Shawn_Douglas on Twitter.
Thank you. And Eric,
LinkedIn and everything as well.
So on Twitter, though I'm quite a Twitter newbie, it's Eric Jardine 7 is the handle. And if you wanted to for example, like look at the geographies report or DeFi reports, other things, the Chainalysis blog, which could be found through a Google search, or is blog.chainalysis.com, will give you access to most of the research that we put out. It's a pretty good resource, I'd say.
All right, thank you. Thanks also to the audience for having dialed in. I hope you enjoyed the discussions. Rajeev, Shawn, and Eric, thank you so much for having joined this panel and having provided your insights on trends in digital asset data and infrastructure. Goodbye, everyone.
It was fun.